The top 100 agents are the best of the best, listing and selling more than any other agent in Australia.
Sold. Congratulations, sir. Well bought.
These are the practices, actions and beliefs of the most successful agents in Australian real estate. Raw, honest and completely uncut. Welcome to REB's Secrets of the Top 100 Agents.
G'day everyone, it's Liam Garman here, and we have a very special crossover episode with real estate business and smart property investment and the
First Property Buyer Show.
Can't forget that. I'm joined by my amazing co-host as always, Emilie Lauer.
Man, I'm so impressed by the pronunciation of my family name by now. Like, you nailed it.
We start off with Emilie Lauer.
Yeah.
People still do that.
Yeah, well, I'm not expecting much, to be honest, but you nailed it.
Yeah, Emilie Lauer, who is the host of the First Property Buyer Show. So if you're listening to this podcast and you know anyone that is in the process of buying their first property, brothers, sisters, cousins, children, make sure they tune into that. A bit of a year in review for First Property Buyer Show because you started it about 10 months ago.
Yeah, I think we started in April or May.
Yeah.
So it's been full on.
Who's been your favorite guest? Or we can't do that.
That is tough one.
What's your favorite topic? Yeah.
You've been my favorite guest. I think, you know what? I think it's been very eventful. We've had like a lot of different guests and a lot of different topics which covered, like the whole process of buying your first property. It started with me looking to buy my property. And then, we had that episode where I tell my journey when we finally bought. But lately, we had one on strategy. And I think this one was made for like first-time property buyers to understand what a strategy is. But it's always a very good reminder, even for investors, to go back to basic and maybe have a little chat with their partners, have a little look up their portfolio and really find that strategy and what they really try to achieve. So I think this one was one of the latest one we did, but very comprehensive and really put strategy simple when it seems sometimes like a big complicated word.
Yeah, well, you got to find the goal and work backwards. And I think one of the big challenges, especially when you're buying your first property or your PPOR, one of the big, I suppose I'll boil it down to misinformation nowadays in Australia, which is, just get on the ladder. But you have to do it strategically now. Prices have moved to a point, and this is the world according to Liam, this is obviously my opinion, but prices have moved to a point where just getting on the ladder, I don't think is a good enough reason, and it's not a good enough excuse, especially when you do have, you do have a lot of strategies out there that you can do. You can rent-vest, or if you're in Melbourne at the moment, but maybe buying a PPOR is you've rolled the dice and you're going to have some really substantial capital growth off the back of it. But the line that we were always peddled was really just get on the ladder, buy anything, it'll grow up.
Yeah.
But there are a lot of areas out there which are not seeing any capital growth. My own apartment is a fantastic example, and I know I've used it as an example a few times. But over the last few years, not really moved anywhere. And you do have to take this strategically because it's now becoming essentially a very unproductive asset. And with things like strata, the bills do pile up, and when you don't have any tax benefits to align with it, you do have to sometimes take a hard look at it and say, is this worth holding? Which is why you have to have the strategy and work backwards.
Always. And, I think knowing when to sell or to release one of the assets is one of the key points in a good investment strategy. And that's what good investors do as well. It's knowing when to sell and really looking hard at their asset and be like, okay, this is not performing. Let's cut the crap in a way and just, let it go, and buy something else that is more productive, So no, I think the strategy point is something that we're going to have to develop a little bit more next year coming into 2026 because the market will change again and it's going to be on the back of this year. And all of the schemes will also play a massive role in shaping next year.
100%. And it is a hard topic to talk about because there is that mindset I think a lot of Australians still have, which is that buy and hold for 30 years. That is not always the best use. And there are times where it works. There are times where it works, but if you're spending several $100s at the end of the month after negative gearing and after rent, but you're going into an asset which isn't growing, you really do have to think, is this worth holding? Now, 2025 has been a big year.
Yeah.
It's been a big year. Looking at bond markets at the moment, I think it's very fair to say that people far smarter than us are predicting that there will be a rate rise.
Oh, no.
Yeah, there will be a rate rise. I think you were talking to the team before around Feb.
Yeah, we need to write the story after this pod. So some banks have predicted that there will be a rate hike in February. Some of them are still hoping for cuts. Which means that it's maybe time to have a chat with your broker and look at refinancing. Either fixing rates, either looking at, switching lenders maybe to get a better rate. But this is something, you gotta have to take into consideration before that RBA meeting. And it's a little bit of a gamble, yeah? It's nobody has a crystal ball. But you need to see what would work better for you. Take the risk. Either it's going to hike, either it's going to hold. It will not go down, that's for sure.
Yeah. And I think looking at, my opinion is pretty well known on this, I think, by now. But earlier in the year, basically all of Australia's major banks, even the RBA, came out with obviously the push and pull factors of inflation. So you've got the kind of push factor behind inflation, which is price of goods going up from overseas, the price of shipping's going up. So therefore, there is a natural growth in the economy. And I use growth very liberally here. It's not good growth, but there is growth in the economy in the sense that your revenue sheet at the end of the year, if you're a cafe, looks bigger. Doesn't mean you're making more money, but it looks bigger because the price that you're charging for a coffee has gone up because labour's gone up, because the price of beans has gone up. You've got that style of inflation, but most of the major banks and the RBA also said there is this pull factor which is driven by the fact that we're looking at the next 10 years of government debts and deficits. And I think we're seeing like $77 billion of underfunded promises here, where we do have an inflated public service. You do have, and these are good things, but public works, right across Sydney, you're building new metro lines, train lines, new highways, which are great things. But what that is several $1 billion going into the economy, which isn't planned for. You also have very high paying jobs on these, which are competing with the private sector. They're competing with the construction market. The trades that are going into building these highways and building new stadiums in southeast Queensland for the Olympics are taking away from construction costs, construction jobs, and the supply of new houses. But with this, they're very clear that it is also the government that is driving inflation, because there is artificial money in the economy which should not be there. And realistically, until the government is very reflective, until the government does something which might not be palatable for a lot of voters, which is finding significant cuts, inflation will continue to rise. And looking at factors like bond prices, and I'm not the smartest person, but I defer to what smart people say, which is why I use good brokers, which is why I use good buyers agents, which is why we do shows like this, because we defer to experts. And these experts are saying, there's going to be multiple rate rises on the horizon, because the government is just flatly unwilling to do anything about out of control spending.
Yeah, well,
but I mean, you know all about out of control spending in France.
Oh my God! Don't even start me on this one. Leave France waiting.
I think what is it like? There's really, I don't know. I was reading a few analysts talking about it, that France is like 3 years away from bankruptcy or something.
Stop it. Like we are, I don't even know what to say anymore, to be honest. Like I see the country going downhill. I see my parents having worked hard for their retirement, which I'm not even sure they're gonna get. So France defeats me, to be honest. There's a reason why I'm here. You know what I mean?
France defeats me.
Honestly, yeah, like it puts my spirit down.
I think a few people have said that in the past, but today we have a fantastic theme that we're covering, which is the 2025 market overview. This is going to be one of a two-part series, so stay tuned for the next series where Emma and I will be unpacking 2026.
Yes.
But we're going to be talking about the 2025 market, and it ties into exactly what we're talking about. We have seen a lot of fluctuations with interest rates. We're now expecting to be rate rises, but I am not overly concerned about property. And I'm not overly concerned about property.
No, look, I think property this year, it was a big property year, 2025. In between the elections, all the property pledges, all the schemes for first home buyers. We've just had the Help to Buy scheme as well introduced for single parents, which this one is a 2% deposit minimum.
Yeah.
So in that sense, property is, it's fluctuating, but it still was, I would say, a good year for property. Investors saw their assets grow. More first home buyers entered the markets. There were a recovery in Melbourne, that started. So I think in that sense, I think it was a pretty solid year for property. Now, of course, there's been issues. Like undersupply, construction issues, the rate drop, so competitions increase, price were being pushed, which is good for investors, bad for buyers. But in that sense, I think, we had a pretty good year in general.
And the underlying levers, you touch on, the underlying levers are there to say that there will be still substantial growth into 2026.
They will be, but experts are saying it would be more moderate. So what they're saying is like the growth will be on the first half of 2026. And then depending on what the RBA is going to do, it's going to slow down. So as usual, some states will see better benefits than others, but it will be more moderate.
Well, yeah, I mean, that makes sense.
Yeah.
You're not necessarily going to have that kind of 30% year-on-year growth that you saw in like Perth or Adelaide. That would defy finance, or would defy economics. But there will be, I still think there will be substantial growth to be had in those pockets, like you highlighted. The 5% deposit scheme that you touched on, I think in your data, in the first month, 5,500 people
something like this.
Nearly 6,000 people in the first month used it. So we can predict that there will be substantial growth off the back of the 5% deposit scheme, especially in affordable areas.
Yeah.
You touched on the Help to Buy scheme, which came in on 1 December, and that's 10,000 homes a year, I think, for the next 4 years. So 40,000 homes, which is a shared equity scheme. So that is people being able to buy with basically splitting the equity with the government. I think it's up to 40% that the government will have. So what you will have is an influx of people who otherwise would not be entering the property market that are entering the property market.
The thing is, like, they're all going to enter the property market under that same brackets of price. So we'll see this price on that bracket go up, and the one that would be below it enter that specific price gap. So I think, the assets you will find for under 900, I think if I remember properly, will not be the same assets you would find under 900 today.
Yes.
So I think it's the asset will not be as good in a way.
Yep.
Because property price will increase in those specific under the scheme limits. So that's where the issue is going to be for some of these people. For some of the first home buyers that's going to enter the market. I think the Help to Buy scheme is also targeting single parents more, which is good because you want to have that security. Now, can you build a portfolio entering those schemes? I'm not sure.
No, and you and I have spoken about this at length. I think it's really dangerous.
It is.
Maybe not the shared equity, but the 5% deposit scheme. And you can see it in the headlines now. There have been so many examples when you read the Daily Mail, the Daily Telegraph, News.com, the really clickbaity stuff about young Australians that are now in negative equity. And I know our listeners have heard me rant over this nonstop, but it is not something that I would advise people do.
Me neither.
Unless they have a little bit of money in the back pocket. Realistically, a lot of I had a friend that was up in Brisbane that was at an auction, and this was about 2 months ago when the scheme first came out. And there were 5 or 6 bidders, and they all stopped bidding at $1 million.
Yeah.
All of them pulled out at $1 million. So clearly off the back of the 5% deposit scheme, because it goes up to $1 million in Brisbane. What you run the risk of is that a lot of the prices of these properties, so 1.5 in Sydney, which it's capped at, you don't get any stamp duty exemptions, for example, over like 800. So you are still paying the full freight of stamp duty. You've got no real demonstrated evidence of savings. At 5%, that's what, $75,000 for a $1.5 million apartment, probably an apartment in Sydney, unless you're, you're looking in very affordable areas. That is, you've got no real demonstrated long-term savings. If you can't save over $75,000, how are you expected to pay a mortgage $7,000 a month, I would estimate? You've got the entry costs you've got the holding costs of a mortgage, which is basically going to be almost all interest for the first 10 years.
Yeah.
And if you do fall into negative equity, if you have a redundancy, clearly you don't have much savings. If you have a redundancy or your partner wants to have a child, you've got the 2.5-ish% listing costs on exit. I think there's going to be an entire generation of Australians out there that are going to take this and they're going to be in serious financial danger if anything happens. And it could be the smallest thing. There could be global economic shocks. And the job that you had today and you were fantastic in, and you might be a top performer in your team, you would have seen it 1,000 times. I've seen it 1,000 times, and you've got entire business units that are just dissolved overnight, no matter how good you are.
Yeah.
That is unfortunately what happens in the working world.
Yeah. I'm also worried about the rate hike for them. Because if you are on the 5% scheme, you already have a high mortgage. Interest rates going up means your repayment will increase.
Yep.
So if you're already tight with what you have, and we know that some people, not everybody, thank God, but we know that some people went to their maximum borrowing capacity.
Exactly.
So what do you do in that case? What do you do? It's going to be very tricky. And we know that mortgage stress is rampant for younger generation. I mean, I think about my mortgage all the time. So I'm like, oh my God, I need to calculate how much I'm the first thing I do every time I get my salary is put in it for my mortgage. That's the first thing I do, just to make sure I have enough money to keep that roof over my head. So, yeah. Yeah,
2 million Australians in mortgage stress. I think what mortgage stress is calculated as over 30% of your, is it 30%? 30% of your earnings going into the mortgage. And as an Aussie, because we're so property obsessed, when I look at 30%, I'm like, yeah, that checks out. I pay way over 30%, and basically all of my money goes into property, which is, when you think about it, a very dangerous way to live.
It is.
And you're going to have this generation of Australians out there which, with any supply shock, can be left in negative equity. They can go to sell and they will owe the bank more than that place retails for because they bought it at an inflated price, which is a very dangerous place to be. I personally, if I was talking at a barbecue, if I was talking to friends, unless you've got a really safe job, unless you're a doctor or a nurse or jobs that, they're going to be around, or unless you're very strategic about it and you have over 5%, but you want to avoid LMI, you want to do this, you're looking to partition it, maybe buy a second investment property with the spare money. If you're being strategic about it, fine. If you're doing it because you have no demonstrated ability to save more than 5%,
don't do it.
Don't touch it. Don't touch it. This is so dangerous.
And I think that's something we're going to see more into 2026 is rent vestings is going to be on the rise even more than what it is already. Yeah. Simply because prices in capital cities will continue to be too unaffordable, especially here in Sydney. I mean, you gotta make sure that your circumstances, because it's so individual, you gotta make sure that your circumstances, you make the right choice for you. Like for us, for example, like I remember when we were launching the first property buyer, we were hesitating whether or not we would go under a PPOR scheme or under a rent vesting scheme. But when we calculated, our mortgage cost us, I think, $50 or $70 more per week than our rent per person. That's the next rent increase we would have. That would have been the same. So for us, it made more sense to go on the PPOR for that specific reason. Yes, we're further away. We're not in King's Cross anymore, but that's what you got. Drummond is a cool place. I like it. I do like it. And I get out less, so I spend less money.
You did get a fantastic buy with that. That was a fantastic buy.
And you know what? I'm going to brag it. That's fine. It's the last of the year. They sold 2 more units in the building, including the one next door to us, which went over $1 million, which means my property went
So
up.
what's the capital return, do you think?
I don't know. I need to look, we paid $955.
Yeah.
The last one went for 1.07.
Yeah.
With 0.27, sorry.
Yeah.
So
pretty good uplift within
pretty
6
good
months.
uplift.
Yeah.
And it also needs reno. So once we do the reno, we're pretty happy with, I mean, we're not going to sell anytime soon, but still it's good to know that you made, in a way, a good investment.
100%. Yeah.
Even though like my the last guest on the first property buyer show, I was like, yeah, we're gonna rent it afterwards. He's like, yeah, that's not a good strategy. Shit.
That's all right. Everyone, but the yields that you're getting on some of the unit markets are actually pretty strong.
It's pretty strong.
I wouldn't worry too much. I also think, like, looking into the future, the economic levers are showing that there has to be, by nature, pretty good growth over 2026. With just record levels of migration, and construction is not keeping up. The government's already, I know New South Wales alone is like 20% behind the National Housing Accord.
Yeah,
so,
I don't know how that's going to happen though.
Yeah, 25% behind it. So the number of houses that we need to build or apartments that we need to build to keep up with a growing population, they're behind. We know that since COVID, construction costs have gone up 40%. So there's no way out of this. And a lot of people are saying, councils need to do more, the government needs to do more in terms of approvals. The approvals are there. There are plenty of people that work in construction or property development have said the approvals aren't the hard part. The hard part is the fact that between approval and, picking up your tools, that the cost of labour and the cost of the construction has gone up another 10% in that time. So therefore we've been priced out. And so it's now economically unwise to be in, for a lot of people, the unit building industry. So a lot of people are pulling out, especially when you can get a government contract and earn a lot more money to support the construction of public goods. On that alone, you're going to have a market where you've got more people bidding for rentals, rental income's going to increase, and investors at the end of the day are going to have more money left over.
Yeah, and you do need the investors for that, because people do need rental. Now, on that point, on the construction point, and I know I've made my point clear so many times already, what worries me is not only the approvals, is the quality of the build.
Yeah.
And we saw it during our search, the building quality is going down.
You had, correct me, you had agents that didn't want to give you strata reports and stuff.
Man, like
wild.
I had an agent that didn't want to give me the name of the builder.
Really?
And I had to not threaten her, but I had to be like, lady, you give me that name or I'm not coming to see.
How do they dance around that?
They're like, oh, I don't know who that is. I'm like, how? Come on. You know who that is.
Yeah.
And look, I think working here for Momentum and working in the property titles helped me a lot, because I knew way much more than other first home buyers that came around to have a look at properties, hence the first property buyer show. But ask the name of the builders. Look them up. When we looked that one up, it was one of those that had to fled the country.
Really?
And basically the bank will not lend you money for those type of property either.
Yeah.
So you're going to be in and you're going to like start looking at the strata and everything. And then the bank is going to cut you off. They're going to be like, no, I'm not giving you money for that. There's too many issues.
Yeah.
We visited one. That was such a weird one. There was one in Zetland that we really liked. We went to see it like 3 times. We really liked it. And they gave us the strata report after like 2 weeks. It's like, ooh, weird. Like
That's
if you
weird,
really want to sell, why don't you give me the strata report straight away? The strata report should be like ready to go.
Yeah.
And then the property disappeared from the market.
Yeah, right.
The strata was crap.
Yeah.
Like they were in going to court with the builder because structural issues, cladding issues, waterproofing issues. They were like, yeah, we're sure to win, but if you don't win, it's like a 25 or 20K more.
Brutal.
I'm like, and that was already like a 1.1 apartment. I was like, yeah, no, that's not happening.
Yeah, the risk associated with it's way too
much.
high. Again, you and I have spoken about this a lot, but the New South Wales Strata Association, New South Wales government report a few years ago, which was 53% of new builds or builds post 2016 have like quote unquote major structural defects. So you're rolling the dice. It's over 1 in 2.
Yeah, no, it's people cut corners.
Yeah.
And you got to be very careful because it's not only, I think for a house is a bit different because, yes, you can have issues within a house, but it's so much easier to fix.
Well, fundamentally, you also own the land. So you can also pull it down should you need to. 53%, major defects. You highlighted, people leaving the country. A lot of these developers have worked out very interesting ways of fluffing up the strata report so it looks nice. And it's very common that they will, upon construction, leave a very nice kitty. So when you do your due diligence, as a lot of people have done when they buy an apartment, you check strata, how much money's in the strata, what are the minutes like, what are the quarterly levies, etc. And you would walk into these apartments and the quarterly levies are low. There's a lot of money in the kitty, but that is completely artificial.
Yeah.
Acknowledging that they know that upon construction that there will be an issue, but let's artificially lower the levies and leave a decent chunk in the kitty. So buyers are essentially duped into thinking, well, the strata is really good. But then after a few years, the levies double and there is no money left in the kitty and you're the one holding the purse strings at the end of the day and you have to cough up.
Yeah, and also like fixing stuff in an apartment costs much more than fixing stuff in a house. Do not do reno.
Yeah. Yeah, you can say that again.
Do not do reno. If you have, what was the meme you saw? If you have that little voice in your 30s.
Yeah, when you're in your 30s, you'll have a little voice saying, do renos. Make sure you don't listen to that voice.
Yeah, do not listen to that voice.
Do not listen to that voice. But I mean, that is I mean, at least a reno, your apartment is a solid build. And there are going to be a lot of people out there that, especially a lot of the people that we highlighted earlier with the shared equity schemes, at least with the shared equity scheme, if it goes backwards, at least the government's kind of liable for half of it. But for people that had a 5% deposit, you look at Parramatta. Parramatta is a fantastic example of you look at sold prices 10 years ago and they're almost identical to today for the unit market, almost identical to today. You cannot bank on these places going up. People do not want them. Obviously, this is a generalization and not financial advice, but you do run the risk of buying in an oversaturated market. And
and that's why you need to really double check what's coming up and the development that's coming up before buying something. Like run the numbers, check what's coming up, if there's like an oversupply coming up or not. And that's the case in Melbourne. Some areas will see tens of thousands of units being built.
Yeah.
So do not buy there.
100%. Yeah, the same goes. Docklands in Melbourne, I think, is a fantastic example of. Yeah, I quite like it. Whenever I go to Melbourne, whenever I stay in Melbourne, I'm always staying in Docklands just because it's cheap, it's easy. But you could walk around and not see a single soul.
Yeah.
And there are thousands of new apartments. I think most of them are Airbnbs now, but just no one is around. You go to the local cafe and it's just empty, even though there are thousands of new apartments. Areas like that, it is dangerous. So, looking at this, we have seen some pretty substantial growth, typically in the outer metro areas, regional areas. Take us through what have you seen in terms of big growth for the year?
Well, regional like areas around the country, especially Queensland and WA and South Australia, went really high. New South Wales, a little bit less. Some areas in New South Wales went a little bit backwards.
Really?
Yeah.
Wow.
Especially in the Bowral regions over there. So that went a little bit backwards. They didn't see...
Bowral?
Yeah, I can't pronounce that.
Southern Highlands. The Southern Highlands went backwards.
I think so, yeah.
Right.
I think so, if I remember properly. They went a little bit...
Beautiful part of the world.
Yeah, it's just too expensive now. It's too fancy.
Yeah.
So it's just not growing as much as the other regional areas because it's such a nice place. We went there like a couple of weekends ago. Beautiful place, but way too expensive to buy something there. So New South Wales was a little bit more, I mean, like Sydney in general, like the whole New South Wales is a little bit fluctuating. Dubbo went really up. But, again, it's a bit further away. It's a bit more regional. Regional Victoria, back on track.
100%.
Geelong, even Frankston is like popping up.
Frankston's hot.
Yeah,
Everyone's talking about it.
It's pretty hot. I wrote a piece that's going to go up very, very soon. Clyde.
Clyde?
Yeah.
Where's Clyde?
So South Victorian suburbs.
Yeah.
Regional.
Yep.
Yeah. Apparently, this one's going up very, very fast as well. High yields, high growth. So I think Victoria next year will continue to see its recovery going up. So I think there's a very sweet spot there for investors if they want to still benefit from lower price and higher yield and higher capital growth. But gonna have to be patient.
Yep.
Like the growth is not gonna come up straight away. It's gonna take a little bit of time. But look, if you're an investor, you're in for the long game. Usually, not on a very fast selling spree.
Well, some
usually.
Yeah, some might be.
Usually.
On the Victoria note, I was talking to a property manager up in Sydney about the new rental regulations in Victoria.
Oh yeah.
And I thought this was a fantastic insight, which was that. Actually, a lot of the 14-point plan or whatever it was, or the 14-year regulations, a lot of those new regulations in Victoria are already in New South Wales.
Okay, interesting.
Yeah. And it just kind of took me by surprise because, in the investor space, a lot of people are skeptical of some of the rental changes in Victoria. However, a lot of those changes that people are skeptical of already exist in other states.
Interesting.
Yeah, which I thought. I just assumed it was a raft of new things, but no, definitely not. So I thought that was pretty interesting. Now, generational shifts. We've seen a bit of a change in buyer psychology, the buyer behaviors. Gen X.
Yeah, Gen X is starting to enter the market.
Gen X. Gen X older.
Is it? Is it not after millennial?
That's Gen Z.
Oh, oopsie.
Okay.
Let's
cut that.
Dennis, Wait, Gen X is what, 40 plus then?
Yeah, I call them old.
Oh, Dennis, cut it, please.
Yeah, Dennis, cut it, please. Gen X emerges as the strongest capital gains cohort.
So it's the 50s. It's the 50s, Yeah, we can.
Younger buyers redefine priorities.
Yeah. And then a little
actually, let's do younger buyers.
Let's do it. Yeah.
Younger buyers redefine priorities, placing less emphasis on size. Okay. We have seen a bit of a shift in buyer behavior, buyer psychology over 2025, and especially with younger buyers, Gen Zs and millennials. What are we seeing there?
So look, there's a couple of property trends there. Like first of all, we saw a big surge of COMO, which is compromise or miss out.
Yep.
So buyers nowadays, and I think it's tied to the demand in the market. There's more competition. So if you're not ready to compromise of some aspects, you're not going to enter the market.
Yep.
You're not going to find that tip-top perfect property within your price range. We wanted 2 bathrooms. We had to compromise and get only 1 bathroom.
I'm so sorry to hear.
So compromise on miss out. We saw people compromise on size of bathroom, of numbers of bathroom, numbers of bedrooms, sustainability as well. People compromise on solar power and stuff like this. garden size and all of this. Now, youngest buyers like the Gen Z onwards, they're redefining the priorities that they want for a property.
Yep.
So size doesn't matter as much anymore. It's more the lifestyle and sustainability shift. So we saw walkable neighborhoods gaining a lot more popularity, both in capital cities and in regional areas. Pet-friendly apartments and units and apartments. Oh wait, Dennis, got that. Pet-friendly units and environmentally conscious homes became like kind of drivers. And that's also impacting new builds and how homes are being constructed today. Because they want to appeal for buyers. And that's, like if you're good developers, you're going to look at those shifts and try to target what people want, basically, to make sure you sell.
Yeah, and those are fantastic items to touch on. I think solar panels add like 2-3% to the value of a house, like $23,000 on average. I think there was some stats coming out from Cotality. So those little 1%ers, they really do add up. Actually, I think the Queensland government came out with a scheme to help landlords. There's a rebate for landlords to put solar panels on their homes, which is fantastic. And if you can leverage the increased sales price with the rebate, there's some good growth to be had there.
Also good for your electricity bills at the end of the day, because we know that energy bills are ramping up, and that's also like putting a dent into, investors' budgets.
100%. Yeah, 100%. Now, I think that is all we have time for today on that. Now, in a moment, we've got part 2 coming up.
Yes.
Part 2, we are going to be talking about how to build yourself up for success in 2026 and what the property market will look like over the next 12 months. Emilie and I will unpack that. That is coming up in just a second, so stay tuned.